Okay, good morning, everyone. Today is Saturday, February the 15th, 2025, and we'll be having a somewhat revision section that borders on consolidated financial statements for a simple group. And on this premise, we will be exploring a past question. I mean, we did past question for May 2024 diets of ICAN examination at skill level on financial reporting. And on this premise, we'll be looking at this question to more or less reiterate our deliberations over time and also to reevaluate our understanding. And wherever we have shortcomings, we'll be able to identify and follow it through from that perspective. On this premise, we can start by the reading of the question. Over to you, Damilola.
Okay. The following are the statements of financial position of Sokoto Nigerian PLC and Nigerian Limited for the year ended October 31st, 2023. Sokoto Nigerian PLC, Nigerian Limited. Non-current assets. Plant and machinery. For Sokoto, we have 2,600. For Niger, we have 560. Furniture and fittings. For Sokoto, we have 1,600. For Niger, we have 400. Investments. Shares in Nigerian Limited at cost. For Sokoto, we have 1,600. For Niger, we have dash. Current assets. Inventories at costs. For Sokoto, we have 1,760. For Niger, we have 560. Trade receivables. For Sokoto, we have 1,160. For Niger, we have 840. Cash and cash equivalents. For Sokoto, we have 800. For Niger, we have dash. Total assets. 9,520 for Sokoto, for Niger 2,360. Equity and liabilities. Equity, 1 naira ordinary shares. For Sokoto, we have 5,600. For Niger, we have 1,360. Retained earnings. For Sokoto, we have 1,720. For Niger, we have 400. Current liabilities. Trade payables. For Sokoto, we have 2,200. For Niger, we have 440. Bank overdrafts. For Sokoto, we have dash. For Niger, we have 160. Total equities and liabilities. For Sokoto, 9,520. For Niger, 2,360. Additional information. Sokoto Nigerian PLC purchased 70% of the issued ordinary share capital of Nigerian Limited 4 years ago, when the retained earnings of Nigerian Limited were 160,000. There had been no impairment of goodwill. For the purpose of the acquisition, plants and machinery in Nigerian Limited with carrying amount of 400,000 was revalued to its fair value of 480,000. The revaluation was not recorded in the account of Nigerian Limited. Depreciation is charged at 20% using the straight line method. Sokoto Nigerian PLC sells goods to Nigerian Limited at a markup of 25%. At October 31st, 2023, the inventories of Nigerian Limited included 360,000 of the goods purchased from Sokoto Nigerian PLC. Nigerian Limited owes Sokoto Nigerian PLC 280,000 for goods purchased, and Sokoto Nigerian PLC owes Nigerian Limited 120,000. It is the group policy to value non-controlling interest at fair value. The market price of the shares of the non-controlling shareholders just before the acquisition was 1 naira 50 kobo per share. Required. Prepare consolidated statement of financial position of Sokoto Group as at October 31st, 2023. Explain how investments in a subsidiary should be accounted for in the separate financial statement of the parent. 20 marks.
Thank you very much, Damilala. Yeah. Please confirm if it's recorded over there. You guys confirm if you could see the recording. So that we can continue. Okay, I think it's confirmed. Yes. Okay. Thank you very much. Okay, we'll continue from there. Now let's switch to our workbook. Today you also have opportunity that we'll be doing it as if we are doing it on the board, but we'll also be making use of tools you will be making use of in real life. Okay, one of those tools is Excel, or the basic of those tools is Excel. Okay, what I've also simply done from what you can see on the screen is my Excel workbook where I've copied the question exactly in pictures, and also I've more or less transcribed it into Excel formats. Which means the same question that has been read is what you can see in Excel format, so that instead of me typing the figures subsequently, I can always link as far as practicable. Okay, which means I'm building a simple model, financial model for consolidation, just at the basic level, because it goes beyond this basic level. Okay, now let's start by identifying if control exists. From the information before me, I could see that Sokoto purchased 70% stake in the ordinary shares of Nigeria sometime 4 years ago. Okay, and we are reporting today, 4 years after, being 31st of October 2023. That means 4 years ago should have been, if I'm right, 1st of September 2019. Okay, 1st of September 2019 to 31st of, no, sorry, 1st of November 2019 to 31st of October 2023. That should be 4 years ago. Okay, I think I'm right, which means 1st of October, November 2019 to 31st of October 2020 is the first year post-acquisition, and between 1st of November 2020 to 31st October 2021 is the second year post-acquisition, and between 1st of November 2021 and 31st of October 2022 should be the third year of acquisition, and between the 1st of November 2022 and 31st of October 2023 should be the fourth year post-acquisition. Therefore, now with information, there's no other information to the contrary. Therefore, presumably, we have significantly more than half of the voting rights. Therefore, without any information to the contrary, we can easily conclude that Sokoto Nigerian PLC controls the operating and financial affairs of Nigeria Limited. And therefore, what are we going to do in this light? Okay. Let's start with step one. Step one is for me to put on the structure. What does the structure look like? Let me borrow my pen. Group structure. Now, this Sokoto and this Niger. Now, that's 70%. And we have the balance being held by the outsiders, which collectively we group as non-current assets, and that amounts to about 30%, all things being equal. Now, date of acquisition, that's what we just delineated. I think if you look at it 4 years ago, is this date. And we are consolidating. Let me asterisk it so that you know we derived it. That's 1st October 2023. It is 4 years apart. Therefore, that is our first step. Our next step, as usual, is to separate the Nigeria's reserve as at the reporting date. Sorry, is it December? No, the year ends. Therefore, let me change this template. This October. Okay. Now, what is the reserve of Nigeria as at the reporting date? If you go back to our balance sheet, I believe you can see my Excel. If you go back to our balance sheet, our retained earnings for the subsidiary is 400,000, since all figures are in thousands. Now, let us quickly delineate this. Since we are aware that Sokoto is the parent, let me just emphasize the parent there. And Niger is a subsidiary. Okay. Now, but as at acquisition, if you could remember, we are told that at the acquisition date, Niger limited retained earnings was 160. Therefore, we take note of this. I can just put it in figures, 160, so that I can link it up. That's where I got the figures from, 160. Therefore, remember it is positive, and Excel will see positive as the same number, 160, sorry. Positive 160, which we have linked. Remember? That's at acquisition. Now, which means when we acquired, the retained earnings was positive at 160,000. But today, 4 years after, we have grown it to positive 400. Therefore, ultimately, what has been our level of performance? We've grown the retained earnings through yearly profitability for over 4 years by how much? By positive 240. And that is our post-acquisition profit. And remember, this post-acquisition profits will become returned to both the parent and the non-controlling interest in the ratio, the share profit or loss. And that ratio is nothing other than this ratio that we have identified, 70-30. Okay, that's the first order. Now, the next order is that at acquisition, we are provided with information. IFRS still requires that at acquisition, the parent or the acquirer should remeasure all of the assets and liabilities of the acquired entity, or the subsidiary in this case. at acquisition date fair value. And as we have explained in the class severally, is to compare apple with apple, thereby letting the current, the assets and the liabilities reflect the current value, or what we could consider as the market price as at the time it was acquired. And this is to ensure that the shortcomings of historical cost accounting was addressed first before determining whatever goodwill may arise from this acquisition or gain on bargain purchase. And that is why we'll do what we need to do. Therefore, on this premise, we are told that they've carried out all necessary evaluation, that except for only plant and machinery that have carrying amounts slightly different from the fair value. And the carrying amount was 400,000 as against fair value that was 480. And we will have ignored this if it has been accounted for in the books. But as we are told that this evaluation was not recorded in the books of Nigeria. If that is the case, therefore we need to pass the relevant entry. And therefore, at acquisition, we do it for all assets and liabilities and aggregate the position together to adjust for the pre-acquisition retained earnings. Okay, but in this case, only plant and machinery was affected. And therefore, what do? We go back to the question. We have the fair value, 400. Let me just say fair value. And let me say carrying amount so that we can see where I'm picking it from. This we are told is 480. Remember, our figure in thousands, and this is 400. Therefore, I can simply link it so that you know where the information is flowing from. Okay, and I can have this and equally link the other one. Okay, I'm looking for the difference in the two. What is the difference between the two? 480 minus 400. That simply means I've revalued this upward. That means this fair value is upward, and that results into a gain in revaluation principle. And what's the implication? The implication is by our accounting entry, the value of asset has increased, and to reflect it within the group is for us to debit the value of asset, as you're all aware. That is how we can increase the value of asset by this 80. And the corresponding entry, as we have discussed several in class, affect the acquisition retained earnings, or because these existed prior to acquisition. And therefore, with the 80,000 naira being the fair value gain arising from IFRS 3 fair value accounting, or fair value remeasurements at date of acquisition. Okay. In that case, that's what I'll do. Therefore, we'll see how we effect these adjustments. Later on. Okay, if there's any question, you can raise up your hand at this point before we move on. Okay. Now, that's the second hurdle we have crossed. Okay, Now, let's go to goodwill computation. And this always come by way of our first principle. If you remember our first principle, cancellation. Okay. Now we need the purchase consideration. Luckily, the purchase consideration has been accounted for in the books of the parent at cost of 1.6 million. And we need to recognize that for the parent, which represents a 70% stake. While that of non-controlling interest will be derived from the methodology. And if we go back, how are we told it is accounted for? We are told NCI's, the group policy, value non-controlling interest at fair value. Therefore, we are going to derive that at fair value. And this is according to the policy of the company. Okay. Now, we'll come back to it. Let's quickly fill in those ones that are already on the surface of the account. The share capital of the subsidiary was this. And the pre-acquisition reserve, if you remember, is what we just derived here. Sorry, we used to derive the post here. It's 160. Now, we've carry out fair value adjustment on plant and on machinery. Therefore, we take note of that, and we are told that we should credit that to pre-acquisition retained earnings, which means that means pre-acquisition retained earnings is no longer 160, it's now 160 plus 80. When you credit a reserve, what you are simply doing is that you are increasing it. Therefore, it is now 240. It is this 240 plus 360 that gives us the fair value of the assets, the net asset of the subsidiary, which we have derived at 1.6. But now we need to derive the fair value of NCI at acquisition dates. Therefore, non-controlling interest, that is NCI, as measured at fair value at acquisition date, which is 1st of November, I guess, 2019, if I'm not mistaken. Therefore, in that case, NCI fair value measurement should equal the market price multiplied by number of ordinary shares in Nigeria Limited as held by the NCI. Okay, now the order is this. We only know that NCI has 30% stake. No information here that gave us the number of shares specifically, but we are given the market price at 150 kobo. Now, since we know the share capital of NCI, and we know that each share nominal price is 1 naira. Therefore, the first order is to cross it by determining how many number of ordinary shares at 1 naira will accumulate to 1.36 million. And therefore, we'll come back here. Though we know the market price, but we don't know the number of shares. Therefore, let me come here. The market price here is 1 naira 50 kobo. Okay, why this is unknown. Therefore, we'll come back to that. Therefore, let us first of all determine the number of shares of Niger Limited. And that will be simply the share capital divided by the nominal price. And that is the share capital, as I've said earlier, was this, and the nominal price is 1 naira per share. Therefore, what do we do? Therefore, if you go by our calculation, it is this amount divided by 1 naira. Okay, let me just try and put it somewhere there. Ordinary share capital and nominal price. Let me put it here so that we can. Where do we have it? This. And nominal price. Let me just put 1 naira. Okay. Therefore, I can say the number of shares equals this in naira divided by this, and we have shares. Okay. Okay. Therefore, we've gotten that. The next step is what is the number of NCI's shares held in Niger Limited at acquisition date. Therefore, that would be simply a percentage. It should be NCI percentage, which is the stake, multiplied by the number of shares of Niger. And that is how much? Again, NCI stake in percentages. And I will put it together. This is 30%. How do I have at 30%? Let me also show you here. Sokoto parent stake in Niger, according to information given to us, was 70%. Therefore, non-controlling interest NCI stake will now be 1 minus 70% or 100% minus 70%. It will give us the 30%. At every point in time, the two stakes must align at 100. Okay, that's how we got that 30 is derived. Take note. Therefore, I'll bring it here. 30 and this that I just derived, I'll bring it here. Therefore, what is my answer? 30% stake in this. That gives me 480 shares. Therefore, I can bring that up here. 480. 408, sorry, 408 shares. Remember, all figures are in thousands. And if I'm to do that, let me put it in red so that you know it's derived. Derived. Okay, and therefore, what does that give us? It simply give me 150 cover. I can put it there so that I make it a model that I can switch. Means the market price and the number of shares. One 50 cover. And I link this to here. Shares. Therefore, what value does it give me? It's 150 cover multiplied by 408. It gives me this value. It gives me this value. Okay. Now we've gotten that. All things being what? Equal. We've gotten that. That's 612. I believe we can confirm it with what we've also done individually and see whether we are correct. Okay. Now I can bring that in. Now that should be my purchase consideration. Now, that means we have goodwill of 612. Now, from what we've done so far, any question? Any question from what we've done so far? Please, you can ask in the chat room, and you can equally raise up your hand so that I can address the question immediately. Okay. It seems we all got it right. No problem. Now, the next order is for us to address some additional information. Now, I think we've dealt with this. Anything we've dealt with. And we are told that there was no impairment of goodwill, which means we've completed that raise. That's completed by assuming there's no impairment on goodwill, is 0. There's no impairment. Okay. Therefore, let me go to the question and let us highlight it. Let me highlight it in yellow. I've completed this. Now we've completed this to this level. But we have not addressed this. Completed to this level. But we have not addressed this. Depreciation charge at 20% on straight line method. What it simply means is that, remember that we have valued it to 480, which that means, and the 80 has not been captured in the books of subsidiary. That means that the subsidiary will have been charging depreciation on 400 instead of 480. Therefore, the depreciation will have been undercharged, and the profit of subsidiary will have been overstated. Therefore, I will come in here to carry out additional depreciation adjustments. On what? On plants and machinery measured at acquisition date. Okay, if that is the case, what happens? Okay, you remember I told you there are 2 methodologies. I'll still repeat those 2 methodologies here. Now, the first methodology is to calculate the depreciation based on fair value. For the 4 years, remember we acquired 4 years ago, which means we'll appreciate it for the last 4 years. And depreciation methodology at carrying amounts. Now for the 4 years, you will have charged 20% per year, because we are told that it's on the straight line. It means 20 years means it should have been depreciated for over 5 years remaining life, and therefore, but 4 years has only been used. Therefore, it's 20% multiplied by 4 years, which means 80% of it is already depreciated. That's what it means. Remaining only 1 year to go. Okay, and if we have applied that same principle on 480, what will have been the amount of depreciation? What will have been the amount of depreciation? We'll compare that with what we have applied on, which is 400. Carrying amount was 400. Therefore, what will have been is for us to say 20%. Let me put my measures here. Depreciation rate. Number of years used up from acquisition date to today. That's 20%. And this is forward 4 years. Okay, and that will give me 20% multiplied by 4 years, multiplied by 480. Remember our 480 here? You now compare the same thing. 20% multiplied by 4 years, multiplied by 400, which means the difference is 64. And alternatively, okay, let me put the alternative here. Alternatively, the same amount you can do. Remember, 20% and 4 years are common factors. Therefore, since they are common factors, what should I do? Let me emphasize that they are common factors. Let me put them in a separate color. Let me put them in blue color. Therefore, I'll extract the common factor. You know, some of you that did arithmetic, they will say, what's the common denominator, LCM, HCM, and the likes. This is where it applies now. This is a common factor. Therefore, the common factor is what I'll bring out, which is 20% multiplied by 4 years. I'll now multiply it by what is not a common factor. What is not a common factor is the difference between 480 and 400, which is this 80. Which means the difference between 480 and 400, which means I don't need to repeat it. I'll just have applied that, but let me just show you there so that it's systematic. Which means if we come here and say 20% multiplied by 4 years, multiplied by this 80, you get the same 64. That's what we are trying to tell you. Which means once you have understanding, you can go any route. Now, what is the implication of this 64? This 64 presuggests that we have under-depreciated the asset, thereby overstating the profit of the subsidiary post-acquisition. It means this profit of 240 has been overstated by this 64. And remember, in principle, we will have distributed this 240. Therefore, we'll come back to retrieve that 64 from those we have distributed to in the same ratio we initially distributed the profit. Therefore, what is the accounting implication here? Accounting entry is that the subsidiary's profit has been overstated. And therefore we have to charge it with additional 64 as an expense. Therefore, we debit the profit. But the consequence of that affects the parent to its consolidated retained earnings to the tune of 70%, if you remember the stake. And also, it affects NCI to the tune of 30%. Therefore, what do we do? Therefore, what do? We debit. That's 70%. Where's our 70% coming from? Remember this? Multiply by that 64. And our 30% multiplied by that 64. And there's a credit to the group, which is also subsidiary, is inside the group, property, plant, and equipment. And how much is it? 64. And that is it. That's our accounting what? Entry. I think all figures are in thousands. Okay. No question yet? Okay. Yeah, I can see some people are also giving me figures. That's nice. Therefore, I think we've dealt with that. Therefore, we come here to highlight it, that we've dealt with it. Okay, okay, let's deal with this. We are told that Sokoto, the parent, sells goods to the subsidiary and always make a markup of 25%. Okay, now let's first of all identify that intercompany. Which is same thing as intra-group sale of goods. Okay, who sold to who? Parent sold to subsidiary. Hence, that implies downstream transaction. Okay, now it's at a markup. Which is profits. Profit P divided by cost C. Profit P over cost C. okay, is 25%. Which means it's 25%. That 25% is equivalent of 25 over what? 100. Let's take note of that. Now, but unfortunately, we were told that one, as at the end of that year, the subsidiary had included in its inventory 360 worth of goods that he purchased from Sokoto. It then means that this 360 refer to the value of goods that were unsold based on the fact that I purchased those goods from Sokoto. Now, Sokoto has loaded profit at a markup of 25%. It then means we need to identify what portion of that 360 represent unrealized profits. And on that premise, we apply it. But unfortunately, 25% is a markup, is a profit on cost, not profit on value. And value is the selling price. And in that case, we need to convert markup to margin. Therefore, how do you convert markup to margin? Recall the margin is profit P divided by selling price S. Okay? So, put it color blue and profit T is color gray. Therefore, also recall that selling price S equals cost price or cost C minus profit P. Hence, I can easily substitute. If you have this, sorry, cost plus, not minus, plus. Therefore, I can easily now substitute. Let me say this is equation, this equation 1. Then I can substitute. That's this equation 2. This equation 3. Now this equation 1. I can substitute equation 3 in equation 1. vice versa. Then markup to margin. And then P over C is our starting point. Therefore, how can we convert C to S? It's for us to add P to C. And that is it. Now, if that is the case, it then means that profit P over cost C plus profit P. Okay, therefore, I'll just substitute what is the value of P. Profit P, I'll just substitute straight. Into the equation. And also substitute that of cost. And in that situation, I have converted. Therefore, what does that mean? It means my value will now be P is 25. C is 100. And that P is 25. Therefore, it will be 25. Let me put it somewhere here. I have 25. And I have what? 100. 25 is for P. Let me put it beside it. Profit P. This is cost C. Okay, what's the color? What's this? And therefore, I'll just substitute and say P divided by C plus P. C plus P. That gives me 20%. This 20% is equivalent of saying 25. This is equivalent of saying 25 over 125. That is what it means. Okay, that is that. Therefore, we have converted. Now, to determine unrealized profits on inventory, it will be the value of unsold stock. Unrealized profit will be the margin now. What's our margin? Which is 20% multiplied by the value, which is selling price of unsold goods, or what you call inventory. Or inventory, which in this case is 360. Have we? It's 360. Let's go back. What is it? It's 360. Therefore, what do we do? That means we come here, margin, and value of unsold goods. What is our margin? 20%. What's our value of unsold goods? 360. Okay, therefore, unrealized profits on inventory equals 20% multiplied by 360. And that gives me 72. This 72, what does it mean? It means the seller, which is a parent, has overstated his profits by 72,000 naira. Why the subsidiary has overstated its inventory value, which you have to reverse or reduce back to its cost. By that, therefore, the accounting implication, accounting entry, is charge the profit of the parent that was overstated, because parent only owns the consolidated reserve, and that's where it's hiding. That's the parent only, and credits the group where the subsidiaries inventory is also hiding. With what? Sum of 72,000 naira being the unrealized profits attributable to intercompany transaction. Okay. That's that. Any question on that? Any question on that? Okay. Somebody say, I'm not getting it yet. What are you not getting yet? Be specific. Be specific. What are you not getting yet? Where are you lagging behind so that we can trail it back? Okay. Nobody's raising up hand. Okay, Kisley. Kisley, you can unmute.
Good morning, sir.
Good morning, Kisley.
Okay, so the part where you substitute equation 3 into equation 1, I think that's the only part I don't really get. Yeah, this then markup to margin equals to
Yeah, okay.
profits all over cost plus profit again. So initially the equation 1 is profit all over cost. So it means the part where we are maybe substituting is the denominator part.
Yes.
Which is the
Yes.
cost part.
Yes, because you are looking for cost and you know selling, you are looking for selling price and you know cost and you know profits. Have you not seen the selling price?
Okay, yeah.
That's it. Now it's substitution. That's the reason why you study substitution. You know, I needed selling price, but I don't have it on ground. What I had on ground was cost. And I also have on ground profit. Have I not known my selling price? Hello? And that is what we've done in that case. That's what we call derivation. If you need A, but A is not available, but you know that there's a relationship between A, B, and C, such that B and C together is what make up A. Therefore, you already have your A. Therefore, what do? You substitute B and C in the position of A. That's what we've done. Eh? Thank you. Okay. Now let's look at, I think the last, okay. We've dealt with this one. We've dealt with this one. Now this is the last one. Intercompany payable and receivable. What they are saying here is that the subsidiary owes the parent 280 million for the goods purchase. And simultaneously also, the parent also owe, probably through borrowing or whatever, owe the subsidiary 120. It means there are two sets of intercompany balances in the group. And if you remember, we said, why do you carry out group adjustments? Is to eliminate duplications and or eliminate unrealized what? Profit or loss where applicable. Now, we have been used to elimination of unrealized profits. Now, we are now going to be exposed to elimination of duplications. What do you mean by duplication? Go back to this balance sheet. Inside this balance sheet, in the receivable of the parent, is that amount. If we just add these two together and put it here, we'll say the group trade receivable is 2,000. Also, when we come to payable, we add these two together. We'll say the group payable is 264. But unfortunately, inside this 1,160 is this 280, whereby 280 is receivable from subsidiary, while about 800 or more is receivable from third-party customers. Also, inside this 420, that is payable by the subsidiary, 280 is inside, payable to the parents, while the balance of 100 and something is payable to third-party vendors. Now, what we have simply done is that we have duplicated the same amount of 280, increasing our receivable by 280, and equally increasing our payable by 280. The account will still balance, but it's not going to reflect the true position, especially when you start to carry out ratios and other matrices. Therefore, what do we do? Is to remove the 280 here, being double counted. You can't owe yourself, because at a group position, both the parent and the subsidiary are one. Therefore, I remove the 280 here. I also remove the 280 here. The equation will still balance. If you remember, mathematically, whatever you do to the right-hand side, and you do the same thing to the left-hand side, the equation every time, every day, every hour will balance. And that is where you truly reflect your financial position, not just balancing the sheet. And that's why the nomenclature are skewed much more to calling it statement of financial position, your true position, not necessarily a balance sheet. What is balancing? No. What is balancing may not reflect my true position. And that's what we are trying to do here. Therefore, what do? We eliminate intercompany balances because of the duplication. Therefore, what do? We come here to carry out elimination. Now there are two balances. Okay. Now, first balance, let me do it one by one. You can always net it up, but let me just do it one by one. First balance, where the subsidiary owes the parent . How much? 280. The second one, how much? The parent owes 120. Therefore, what do we do? Because the payable has been overstated, the subsidiary payable from the group perspective has been overstated, therefore coming group, but coming from subsidiaries payable, we'll debit that. If we consider this aspect to be debit, okay, let me put here. And this aspect to be what? Credit. And I will credit group also because it's still consolidated, but from the parent aspect, where we have trade payable, receivable. Receivable is an asset because it's overstated. Because of duplication, I'll credit it with what? With the 280. Similarly, I'll do the same thing here, but just opposite. Therefore, it's a parent that is owing in this case, and the subsidiary that is expecting receivable. Regardless of it, it's still the same implication because both parent and subsidiary are consolidated. But the only difference here is the value, 120, if I'm not mistaken, and 120. Therefore, we've completed everything. Now, at this point, okay, Dabilala, you can unmute.
Sorry, sir, I have a question.
Yeah.
So, since for that subsidiary, since is the parent is owing, and the subsidiary is the one receiving, are we not supposed to debit subsidiary and credit the parents?
If parent is owing, therefore, in subsidiary book, what do you have? Trade payable or trade receivable?
Subsidiary, we have receivables.
Therefore, and if it's overstated, what do? You want to bring it down. If you want to bring an asset down, do you debit
You
it?
credit it, you credit.
That's what we've done.
Oh, okay.
Remember,
Okay.
we are eliminating, we are removing from, not we are adding to.
Okay, okay. Get it.
Let me emphasize, elimination means removal of duplicate, I mean. Okay, that's it. Now, let us quickly now balance the equation. I think we've finished everything. Let me just try and put something here. Therefore, let's do our last working year. Consolidated retained earnings and non-controlling at 31st October 2023, all things being equal. Okay. Consolidated retained earnings, NCI. All figures in thousands. Therefore, we start with Sokoto's retained earnings. What's Sokoto's retained earnings? Is this? Next, non-controlling interest at acquisition date. Remember, we derived that. Sorry, where am I putting fluctuations? NCI at acquisition date. Remember, we measured NCI here. That's 612. Share of post-acquisition profit. What ratio was that? 70% to 30%. Can you remember? Therefore, 70% of, remember we determined that 240 before, 30% of the same thing. Okay. Remember, therefore, group adjustments. The first one is additional depreciation on plant and machinery. And what was the adjustment, if you remember? We said we should debit the parents and the NCI. Okay. That is negative. And the NCI, negative. Second adjustment that affects it is intercompany cost of sales, unrealized profit, which affect only the parents. Unrealized profits on inventory. And let me emphasize it. It's a downstream, and that's why NCI is not affected of it. Downstream transaction. Only parent is affected, negative. 72. Okay. Which other adjustments? No, this doesn't affect balance sheets. Okay, goodwill. No impairment. Otherwise, it will have affected both of them or at least parents. If remember, the goodwill we derive here, is it full goodwill or partial goodwill? Okay, I've even released the expo. It's full goodwill. Why is it full goodwill? It's because we measure NCI at fair value. Therefore, it means if there's impairment loss on full goodwill, it will have affected both the parents and the NCI in the proportion they share profit or what? Or loss. But in this case, there's none. Okay. Therefore, that's all about the adjustments. Let me put the adjustment in amber. Therefore, we can sum up. All things being what? Equal. Okay. Any question at this point? Okay, if there's no question, now, okay, Brian, over to you.
Yes, sir. Please, I want to ask a question regarding treatment of the plant at fair value at acquisition.
Yeah.
So initially, according to my understanding on how you're supposed to treat a revaluation on plant and machinery, you're supposed to like increase when it's the revaluation surplus, you're going to increase the value of the asset by that figure, which it has been increased by, and then credit the revaluation surplus. So I was not like, how do you treat the second leg of the revaluation after we increase the value in this case?
What is second leg? Second leg is your reserve now, which means you credit your reserve.
Yeah, but I feel that is just meant to it's meant to assist us in calculating our goodwill.
I don't understand. It's not assisting. When you value upward, two entries are passed because
Yes.
two accounts are affected. One is the asset account, one is the reserve account, and you have passed it. Therefore,
Yes.
what else? What's the specific
Okay, I think
question?
so. I was thinking we have only recorded the revaluation increase in the assets, and that's
We've
all.
not done on the reserve, have you?
Yes.
You've seen it
We
here now. We incorporated it here now. What is this? Probably let me put it in red. We incorporated it here now. What happened? Our retained earnings was no longer at acquisition, was no longer 160. It's now what? 240.
240.
Did you see it?
Yes.
Okay, thank you. Okay. Any other question? Any other question? Okay, if there's no question, now we've done that. Now, other things are very easy. We'll just insert them. I've already created the templates. Okay. Now, PP. Let me just, you don't need what I'm trying to do now. Is at 260. I think that will delay me, but I'll put it up if time still persists. Your PP is what? The parent plus the what? The subsidiary. Now, the entry we pass is to increase the value of the assets. PP, remember, we debit it. Group property, plant and equipment by how much? The evaluation or fair value gain of 80. That should have given us 3240. But remember, we computed additional depreciation on it, which we said we reduce it further based on cumulative 4 years of 64. Therefore, this gives us our PPE, which means for PPE, let me just emphasize it again. Value added parties is 26 plus 560 plus 84 minus 64. And I'll put those ones in red. That's how we got this. Investment has been canceled out. Remember, initially we have investment of 16, and we've taken the entire investment out here because it constituted purchase consideration of Sokoto. There are instances where it will not totally cancel out here. Why? Because this investment will not be only for Sokoto. It might contain other financial assets. Let me say what is here is 18, but they told you that it's only 16 that belongs to Sokoto. It's only that 16 that we are going to eliminate out of it, so that whatever is left is the investment in financial assets. Okay, Kingsley, I'm coming. I've seen your hand. So that not every time you just jump to say that you are taking it out. You are only taking out of this 16, you are only taking the portion that has been used at the point of cancellation out. Which means if that portion is more than that, the balance represents other financial assets. Okay, Kingsley, can you raise up your hand again? I can't see you again. Okay, over to you.
So I was thinking that 84 is 80 because the difference
Okay,
between
sorry,
480
80.
and 480 and 400.
Yeah, it's 80, sorry. I don't know where the 4 is coming from, probably because I've not eaten. Thank you. Okay. Now goodwill. What was our goodwill? What was our goodwill? After impairment, 612. There's no other tangible assets. If there's other, you put them there. And the reason why I'm emphasizing it here is that I've told you that goodwill have to be separated from other intangible assets. Okay? What next? Okay, I've not even, sorry. I didn't add furniture and fitting. It's only plant and machinery. Okay. Let me add furniture and fitting too. That's 16 plus 400. Sorry. Therefore, we omitted that here. 16 plus 400. Because they splitted it. Okay. Inventory. Inventory is 1760 plus 560 minus. What was our unrealized profit on inventory the other time? That was 72. Okay, it was 72. We'll remove 72 from it. 72. Okay, let me put it in red. Every adjustment will put it in red. And therefore, what does that give us? This plus this minus 72. That gives me 2248. Trade receivable. That's 1160 plus 840 minus, remember there are two eliminations we carried out. First one was 280 credit to receivable, another one was 120. Regardless of whether it's parent or subsidiary, it goes into the same group. Therefore, I'll remove 280 and 120 from it. What does that give me? I'll come in to receivable minus 280 minus 120. That is that. Cash and cash equivalents, that one, there's no adjustment for now. That one is just a mere 800 plus 0. Therefore, 800 plus 0 is 800. Sorry, what happened? Okay, this is not 0. Okay, I put that there, 0. Yeah. Okay. Now, ordinary share capital is parent alone. I think we all know that. Why is it parent alone? Because we've canceled out that of the subsidiary. Okay, consolidated retained earnings, I think we've done that. Yeah. We are able to get the equity of shareholders of Sokoto. Now, what about NCI? We've done that. Okay, and that's total equity. We don't have non-current liability. I only inserted that so that you know that you don't always just jump at current liability. There is a possibility that you have non-current liability, including deferred tax liability or loans. Okay, payable is 200 plus 440 minus, remember, we have 280, 120, and I'll show you again. Where is it coming from? This 2.2 plus 440 minus, remember, this 280 and this 120. And bank overdraft. You don't net it off with cash and cash equivalent. You only do that only in your statement of cash flows. But in your balance sheet or statement of financial position, you don't. You leave it as a liability. That's 0 and 160. No adjustment for now. Therefore, how do I write about it? 0 and 160. That's it. And therefore, our account balances. Any question at this point? 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 Okay, let me read examiner's report. Let me switch the screen. Okay, can somebody read the examiner's report? Who will volunteer? And let me give you access. Who will volunteer? Okay, I've seen a hand. Okay, proceed.
Examiner's report. The question tests candidates' knowledge of preparation of consolidated financial statements and how to account for investments in subsidiary in the separate financial statement of the parents. Most of the candidates attempted the question and performance was above average. The candidates that attempted the question were able to carry out the consolidation of the subsidiary and the parents. However, some of them could not correctly determine the net assets of the subsidiary and the goodwill arising from consolidation, as well as the consolidated retained earnings. Also, others could not explain how to account for the investments in subsidiary in the separate financial statements of the parent. Preparation of consolidated financial statements of simple group is a section of the syllabus that is examined regularly at this level of the institute examination. Hence, candidates are advised to pay special attention to the provisions of IFRS 10 consolidated financial statements.
Okay, before you move further, I will also emphasize that it's not only IFRS 10. If I'm to write this exam report, I'll have started with IFRS 3 because that's where you have the knowledge of the goodwill and the fair value measurement. Okay, followed by consolidation itself, which is IFRS 10, and followed by IAS 27, separate financial statements, and also followed by IAS 1 itself, that gives you more knowledge about the order of presentation of financial statement. Now, let me warn some of the candidates or let me say an advice. Sometimes they might give you the balance sheet or statement of financial position in an order that does not reflect IAS 1. And if you consolidate and return in that same order, it's going to affect you because they expect you as a professional that even when problem is brought to you and certain problems are not identified by the person that brought the problem, it's your own responsibility as a professional to be able to identify such a problem, which means you don't wait until problem is identified on your behalf. You as a professional should have that capability in identifying the problem at every point in time. Now, to fast track it, you could see the marking guide, okay? For putting title, you get a quarter mark. For getting the total current asset, you get 1 mark. Goodwill alone, 5 marks. Working to get your total consolidated non-current assets is 1.5 mark, which means if you miss anything there, you lose that mark. Presentation of consolidated current asset is 1 mark. If you miss anything in any of the elements, you also lose that 1 mark. Stating consolidated total assets is a quarter mark. Stating your equity is 3/4. Working for consolidated retained earnings is 1/4. Determining NCI is 1/2. Consolidating liability is 3/4. Working for consolidated current liability is 1. Stating total equity and liability is 1/4. Determining unrealized profit is 3/4. Accounting for investment in the separate financial statement, that's those methodologies, that one carry the other 3 marks. That's just straight. Okay, now let's look at the other question that was asked. What was the other question? The other question says, explain how investment in a subsidiary should be accounted for in the separate financial statements. Okay, let me take you back to the material I provided and the explanation we provided over time. Sorry, I think I skipped it. Okay, can somebody volunteer to read other than the person that read last? Who will volunteer? Okay, Kingsley. read accounting for investment in parent separate financial statements.
Okay. Well, I'm trying to brighten my screen. Okay, accounting for investment in parents, separate statement of financial position. IS 27, separate financial statements, requires an entity preparing separate financial statements to account for those investments at cost, equity method as described in IS 28, or in accordance with IFRS 9, financial instruments. IS 27, separate financial statement, contains accounting and disclosure requirements for investment in subsidiaries, joint ventures, and associates when an entity prepares separate financial statements. Separate financial statements are those presented by a parent, that is, an investor with control of a subsidiary, or an investment with joint control of or significant influence over an investee, in which the investments are accounted for at cost, equity method as described in IS 28, or at fair value in accordance with IFRS 9, financial instruments. Technical
No,
note.
yeah. Okay, continue.
Technical note. Financial statements in which the equity method is applied are not separate financial statements. Similarly, the financial statement of an equity of an entity does not have a
that does not,
subsidiary,
that
associate,
does,
or joint
no,
venturers.
repeat it. Similarly, the financial statement of an entity that does not have a subsidiary, associate, or joint venture
Joint
interest
ventures
in a joint venture
are
are
not.
not separate financial statement. Therefore, the simple thought is here that in line with IS 27, okay, you can only use two methods for a parent that has a subsidiary. Because now I've limited it to a parent. I've taken out investors with joint control or investors with significant influence. We are coming back to that when we get to investment in assets and joint venture. But here we are dealing with investment in a subsidiary. Therefore, for a subsidiary, that's why this technical note has delineated it. You have to measure it either at cost, which is in line with IS 27 as stated up here, or you measure it at fair value, which is in line with IFRS 9, financial instrument. Now, let's see what your examiner gave. Oh yeah, can you read the answer they provided for you? For 3 months. Can you read it, Kisley?
Accounting for investment in subsidiary in parent separate financial statements. Method 1, or as cost method. In accordance with IS 27, separate financial statements, the investment in a subsidiary is recorded at cost in the parent's separate financial statements. Dividends received from the subsidiary are recognized as income. Fair value method. In accordance with IFRS 9 financial instruments, the investment can also be measured at fair value through profit or loss, or fair value through other comprehensive income, depending on the parent's business model.
Okay, thank you very much. Now, the aspect where they talk about dividend received and the aspect where they now tell you about fair value through profit or loss, other comprehensive income, are things we are going to discuss when we get to financial instruments. And we'll be using the following standard, IS 32, that borders on the presentation of financial instruments. IFRS 9, that deals with the angle of measurements, recognition, and other areas, including impairments, edge accounting, and the like. And we also deal with IFRS 13 there, where we'll be talking extensively about fair value measurements and its methodologies and hierarchy. Okay? And in that breadth, we'll have better understanding of what is financial instruments and how our financial instruments are accounted for. On this premise, is there any other question? Otherwise, I think we are on track at 10 a.m. on the dot. If not, I'll share the Excel model with you on the WhatsApp group, and you will have access to it. And also later, once this is uploaded also on YouTube, I will ensure I attach the link, Google Drive link, where you can download the Excel worksheets. Okay. In the absence of nothing to the contrary, I'll say, Sarah, what will be, will be. Thank you very much, and God bless you all. Bye.